Good afternoon, everybody.
It's the same form as him.
You guys can hear me and see me? This is all working? Everything's working? I think I'm on YouTube. I think I'm on the virtual trading floor. All right, we're in business here. Market's not in business. But let's do it. All right, so disclosure. Got to keep the compliance department, they're sitting right over there, happy. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. So that's the disclosure. Here's my position disclosure. I mean, I did keep a little bit of stock, throughout the time of my vacation, but it was a great time to step away, being relatively lighter, and then, was able to do some ads at the right spots, and I got into a little bit of NVIDIA today, very small. Sounds like Micron, last I saw, is down on its earnings report, and got into a little bit of Pinterest today, which is actually one of my better names, even though I was small. So that's our disclosure. Let's get over to the charts. So we are almost done with the month of September here. Tomorrow's the last day of the month. September, just from a seasonality perspective, historically is the worst month of the year. And I'm sure, whatever our statistics are on the average, performance of the market in any particular month, this month of September is helping to drag down what is already a pretty bad average. And today was once again just a ruthlessly brutal day. The S&P closed down 2%, the NASDAQ closed down 2.8%, the IWM closed down 2.2%, and you had, Apple 5% today. And, that's with everything being off lows into the close. A little bit of a rally into the close, but you still have Apple down 5% on the day. Micron trading slightly lower on earnings right now, and Nike up small since the report. Okay, we can take a closer look at that later. Let's switch over to our big picture technicals here on the charts to kind of start with that. Just a ruthlessly bearish day. It started with the 8:30 a.m. numbers that kind of came out, and let me bring up the pre-market chart real quick, because this same principle just always holds true. When you have a negative Maribozu, negative reaction to news, you're generally going to be better off being short than long as that negative reaction never gets negated. So at 8:30 a.m., the 8:30 a.m. high, we discussed this in the morning meeting, is 367.39. So as long as we're below that, the market is what I like to describe as it's guilty, right? It's guilty, and it has to prove its innocence. How does it prove its innocence? It proves its innocence by negating the negative Maribozu, by getting above that price. And we actually had a decent little opening bounce. Actually, sorry, that was in the morning meeting. When we were doing the morning meeting, we had a little bit of a bounce here, but we never recaptured the level. And the second the market opened, it was just ruthless selling. Very impressive selling, actually, because we had a pretty big gap down. So going back to the 5-minute chart here, intraday, we had a pretty big gap down. So here's just some general principles that we can think about when we're trading the open and we're assessing our gaps and our ranges and things like that. It's always really important to understand extension and extension on multiple time frames. And like I've spoken about a million times, and maybe there's some newer traders here on the team, the way that I measure extension is by where the market is trading versus the space between the 8 and 21 EMA, which is my blue and red lines here. The blue line, the 8 EMA in a downtrending market, is going to be that lower band of equilibrium. The red EMA, the 21 EMA, is going to be the upper band of equilibrium. So this space here is the equilibrium zone. And whenever the market is below the moving averages or above those moving averages, you have a market that's extended to some degree or another. The first thing that we need to understand about an extended market is that an extended market can always become more extended, especially when there's volume, when there's momentum, when there's news. And we certainly had momentum coming in right off the open. But it's not going to be able to stay extended forever. Eventually, all markets will have to correct through price or time. Price correction means that the market goes time correction means that the market goes sideways and allows those moving averages to catch up. A price correction means that you basically get a retracement in the opposite direction. So this morning was about as bearish as you could possibly get, right? We had the number come out at 8:30. The market sold off on that. We know that the 367.40 is really important for the SPYs. We never even tested that intraday today. We gapped down, and the gap down was so large that it had us extended right off the open. But even with that, what do we know about opening price action? That first 15 minutes of the day is when we get the most amount of opening momentum, because there is what's the term that I'm looking for? Price discovery. There's price discovery occurring at the open. You get a lot of opening momentum. The market is always less liquid when the market first opens, and that is also when a lot of funds and execution traders are immediately buying and selling their positions, based on what they need to do, and they're doing it in a less liquid market. So on a day like today, we get this big gap down. It probably trapped some people from yesterday's rally, and that just adds to this opening momentum. The first 20 minutes here were ruthless. So we opened up extended to the downside. Usually when we're opening extended because of a large gap, what I want to see, I usually don't want to be aggressive right off the open on a day like today. I want to see how the market handles the extension. This move here is a less probable move generally. Maybe it increased the probability if you think about the fact that some people were probably trapped. But when you're opening up extended and then you just immediately even sell even further and become even more extended or maintain that level of extension, that's going to tend to be a lower probability move, but it doesn't mean that it can't happen. And if it's going to happen, it's probably going to happen during that price discovery period when there's less liquidity, but funds are moving in and out of positions. So you just see this ruthless selling here for the first 20 minutes. And again, that price discovery with the thinner market, that usually occurs for about 15 minutes or so. You guys hear me talk about 15-minute extension at around like 10:15 to 10:30. That's when we really need to start paying attention to our 15-minute extension, because it's usually about that time in the morning, 10:15, 10:30, that 15-minute really kind of comes in play, and it becomes just much more difficult for the market to not correct through time or price if it's extended on the 15-minute at that time of the day. Well, the 5-minute chart's similar at about 9:45. Sometimes in a really bad market as late as 10 o'clock. So that's why you guys heard me say, all right, this is crazy. Wow, we gap down, we're extended, we're just selling off, we're selling off, we're selling off. But once this third bar closed and we're going into this 9:45 a.m. period, I'm like, all right, I'm looking for a signal, and I still want a signal. I don't want to just catch a falling knife. I don't necessarily want to just put bids out unless I'm doing it with a very small, feeler type position. I want to look for a signal that we could get some sort of bounce back. And again, usually in this type of environment, between 9:45 and 10, you're going to get that, usually around 9:45. And this was so weak, this bounce back. It was really, really bad. We finally got a little bit of a snapback. This third bar of the day is that first green 5-minute bar of the day. The bar after that going into 10 a.m. is an inside 5. It's a rest bar. So we had these kind of a little bit of a price correction, even more of a time correction. And I know we called out, just seeing what these other charts look like. Yeah, it's the same. I know we called out this inside 5 here. I said with this inside 5 at 9:55 a.m., you could probably take this in either direction. If it breaks down, then you can be looking for further downside momentum to be able to come into the market. The thing that was a little bit tricky about it was this inside 5 broke down when the market was even still extended on the 5-minute chart. A little bit less extended because we got 15 minutes of price and time correction here, but this was not even enough time for the market to satisfy 5-minute extension, and now we're talking about the fact that it's almost 10 a.m. That's really incredible. It just shows you how tremendously weak this market is. And this is another situation I think is rare. And I said at the time, you could short this inside 5, but we're still extended. This ADMA hasn't even caught up yet. And it worked if anybody took it as just a momentum continuation trade to the downside. But, oh man, incredible weakness. That led to this next leg of the sell-off. And we discussed, the importance of negating the 10 a.m. bar because that was a higher volume negative Maribozu. That was the continuation of this bear flag pattern that kind of came in. But there it is, bam, we get the continuation, another 1, 2, 3 red bars in a row. And then finally we get this little doji at 10:15. And then this was the second time I called a long out. I called it a long out off of this low. So the bounce off it was extremely weak because of how terrible the market was. And the second call out was this low, which turns out to be the low of the day for the IWM. I know SPYs and Qs eventually made new lows just because the market was, once again, so incredibly weak. But this was just a fantastic spot to take those longs. Because now at 10:15, going back to what I was just talking about before, it's between 10:15 and 10:30 that we're actually expecting this market to be able to give more of a 15-minute correction. So a 15-minute correction, there's a couple ways you can look at that. One is you can just look at a 15-minute chart, right, obviously, and look at the same things I'm talking about, the space between the 8 and 21 EMA on a 15-minute chart is the equilibrium area. As you can see here off that low that got called out, we had a perfect bounce back to the 8 EMA, a higher low, a higher high, deeper into equilibrium before the market fell apart again. Or another way that you can even look at it, you can even have an understanding of a 15-minute chart looking at a 5-minute chart. Because the 21 EMA on a 5-minute chart is usually a very similar price to the 8 EMA on a 15-minute chart. So if you get a 5-minute price correction that is deep enough to get to the 21 EMA on the 5-minute, that's going to almost always coincide with a 15-minute correction to its lower band of equilibrium, that 8 EMA. But this, 10:15, 10:30, that's when we really got to pay attention to downside extension on a 15-minute chart. And you can just see here, you can eyeball it or you can try to measure it. You can see here the SPYs at lows at 10:15 a.m. are putting a low of 360.59, and the 8 EMA is $5 above that, just about $4.50 above that. That's a tremendous amount of extension on a 15-minute chart at this time of the day. And this is the exact time of day where we should expect to see some price and time correction. Once again, similar to what I was just saying when we were analyzing the 5-minute chart here at 9:45, I don't want to just be throwing bids out and trying to catch a falling knife, right? I still need an execution signal. What is an execution signal? An execution signal could be a doji or a hammer, ideally confirmed by higher volume, something like that. You want to see some sort of tail come in. And on the 5-minute chart here at 10:15, not ideal, but you get a little bit of a doji, you get a little bit of a pickup in volume, and if you look at this candle and what a doji represents, which is indecision or change, and you couple with the increase in volume, and you couple with an understanding of time of day and extension on the 15-minute chart, you say to yourself, all right, I could have a decent risk reward here to look for an upside snapback on a 15-minute chart. And that's exactly what I was looking for when I communicated to everyone, all right, I think we can look for longs here again at 10:15. Sounds like a bunch of you guys actually bought the IWM on that, which is great because the IWM is the one index that actually didn't make a new low. SPYs and Qs eventually did. And some of you guys bought individual stocks. I bought some individual stocks, honestly, with mixed success. But we got the bounce at exactly what we were looking for. We got the full 15-minute correction. You can see that here on the 5-minute chart with the bounce back to the 21 EMA. Or we can click over to a 15-minute chart, and you can see we tailed all the way up into the 8 EMA. It's a perfect correction. And then we got a little bit even further continuation here before the market, once again, eventually fell apart. So when you're taking this trade, you got to keep in mind, this is a counter-trend trade, counter-momentum trade. Counter-trend trades are more difficult than with-trend trades. As a general rule, I prefer to trade with the trend. Unfortunately, the market wasn't giving us a whole bunch of signals here to actually put those shorts on. Again, this inside 5 and down was actually called out for momentum continuation. I personally think that's a difficult trade. It's a difficult trade for me because this 8 EMA never even fully caught up like I was just talking about. So we never really got a great opportunity to be able to short this down move because we just fell apart the second the market actually opened. But we did nail this low here. So on a counter trend trade, get your risk covered as fast as you can. Because the most likely thing that's going to eventually occur when you're taking a counter trend trade is that you will get stopped out. That's what's most likely going to occur. And eventually, even with this trade, it does happen, though it doesn't happen until hours later. Get your risk covered. Take some more off. Even though we're looking for a 15-minute correction, there's no harm in taking a little bit more profit on a counter trend trade into the 8 EMA on the 5-minute chart, into the 21 EMA on the 5-minute chart, or, again, the 8 EMA on the 15, the 21 EMA on the 15. Those are upside targets. and then maybe you want to keep a very small amount of stock just in case this retracement higher actually becomes a full-on reversal. And especially if you think about the fact that the market's got support here in this 360 area, you want to be looking at that for, maybe the daily chart support can come in for that double bottom, could still potentially be in play. So maybe even actually want to be a little bit more greedy on this because of where the daily chart is and the potential of this daily chart double bottom than you might be otherwise without that extra layer of probability that slightly increases the odds of an upside reversal, which obviously did not occur. We really retraced hard. We did actually give a full reversal on a 5-minute chart, but it's just a 5-minute chart. Our other time frames did not correspond. The 15-minute maybe gives you a little higher high, higher low. If you start looking at a 60-minute, it's not going to be there. And then obviously, new lows eventually come in for the SPYs. New lows definitely came in for the Qs, which are very weak. The IWM held, and that's very notable. I love when the IWM is relatively strong. It's been important for this market for a while, and I think that we even noticed. I'm trying to remember where. Somewhere in this down move. I honestly don't remember where. To try to figure it out looking at the chart. I started to see a little bit more relative strength in the IWM, just that it wasn't having a down move in the same velocity as the SPYs and the Qs were. So I'm not super surprised to see that the IWM was the one index that did not make new lows. So for some of you guys who actually bought the IWM down here, I'm really curious to know if any of you still have it into the close. Maybe you kept that small percentage, 10%, 15% of your position, giving it all the way back to your original stop loss because you got your risk covered. You sold more at the 80 EMA, you sold more at the 21 EMA, you sold more at the 21 EMA and the 15, and you're like, what, I'm keeping 10% of my position just in case we double bottom here on the daily chart with some IWM relative strength. And you actually got an okay close here on the IWM daily. If your price, because again, I know a couple of you guys said, hey, I just got my 1-to-1 in the IWM. If your price is, 164 quarter, whatever, in the IWM because you bought that signal and it never made that new low, it never stopped you out, and you got to close here above 166, you got a $2 plus cushion on a $164 ETF. You can keep that. And if you got stopped out at 1050, I think that's way too shallow of a trail, to be honest with you, because you can't even trail yet because it didn't reverse. Eventually you could probably trail off of this pivot, and then maybe you're getting stopped down into the afternoon on this pullback if you trail tight, and that would be just fine. It is okay to trail your position, especially when you get a little bit of if it's counter trend trade, you get a little bit of a reversal, to try to lock in the profits. Sometimes, though, if you've got a daily chart that's at a major support level, you want to say to yourself, what, I'm not going to trail 100% of my position. Maybe just a little bit of it I'm going to give all the way back down to lows no matter what. Again, small. I'm talking small. 10% of the position, just in case this upside retracement actually becomes a full-on reversal, and I can close with a $2 profit cushion here. And now at the end of the day, I got a false print here, which is not helping how my chart looks. But at the end of the day, if I get a doji here with the IWM, it's still kind of holding lows. Maybe that idea I discussed in the morning meeting of a snapback to the upper 370s in the SPYs, corresponding to that would be a move to, I don't know, 173, 174 in the IWM. All of a sudden, then you get a lot more reward for the initial risk that you put on, even though it's just for a smaller percentage of your position, and that actually becomes very worthwhile in that time. So that's kind of the intraday of the market. The afternoon I just thought was difficult, sloppy, choppy. We petered out up here, eventually made those new lows. I know there's a little bit of a higher low that got called out here at 3 o'clock that led to this afternoon rally. I really don't think that there was much to do in this entire afternoon session except for grab your popcorn and watch the bloodbath, because it was a bloodbath. It was an absolute bloodbath. You look at some of these stocks, look at Apple off that news. Apple held that 145 and had the bad news yesterday, gets the downgrade today, and gets absolutely thrashed. Just a total crazy day. Google never tested the $100 that I was looking at. Palantir, look how well this Palantir actually still held in. I know we were looking at Palantir for a move through $8 off the open. I bought this thing at the open. I think I bought $8.05. My stop was My stop was $7.95, $10 worth of risk. I had an offer at $8.15. The high was $8.13. I didn't get my risk covered by 2 pennies, then got stopped out. This would have been a beautiful trade, I think, if we had any market help at all whatsoever. And just think about how well this Palantir held in the face of what the SPYs, what the Qs actually did today. So right idea, in play name. You hope that lowers the correlation in the market, but even with that, market was just too brutal for like any type of opening long trade to actually work this morning. And that's basically all I think I got for you guys. Just going back to the daily chart, losing yesterday's low is obviously no good for this market. Closing below yesterday's low is no good for this market. We're still roughly into the support zone. So I think a lot of the things I discussed in the morning meeting are still kind of in play. This is a technical bear flag that we're building out. The ADMA is totally caught up, so you could argue that this is primed for downside continuation. The flip side, you want to be a little bit bigger picture. You could say, hey, potential of a double bottom. There's some support here. Let's see if we're able to at least hold this and get a bigger bounce, or be even a little bit more bigger picture and say, hey, we are downtrending on multiple time frames. This market looks terrible. Let me just stay out of the way until we get an actual signal that we're breaking higher. And then, it's like I said in the morning meeting, if we're actually getting above 370, 372, then you could look to be a little bit more aggressive to the long side. But we were never even able to recapture that key 367.40 that we discussed in the morning meeting, let alone go after 370. So that is all I've got for you guys. It feels great to be back working with everybody again. Sounds like I wasn't missed too much because Pat held it down so well. But glad to be doing the meeting again. That's all I got. I am happy to answer any questions that you guys may have, even as I'm feeling a little jet lagged. First thing I'm seeing here is from Andrew Lee. Does your comment about Maribozu only apply to negative Maribozus, or can same logic be applied in the positive direction? Absolutely both. It is 100% both sides. So those Maribozu candlesticks, and I have a candlestick class, Andrew, I don't know if you've seen it, where I kind of get into this. The positive and negative Maribozu candlestick is a really important read on the market. So one of the ways, and I stole this from Brian Shannon, who's a technical analyst that I really like. One of the ways in which I like to view the market is in terms of innocent until proven guilty, or guilty until proven innocent. And that Maribozu candlestick, especially when there's news or high volume, is that candle that can put the market into the penalty box, or do the opposite, really make the market innocent until the market's able to prove it's guilty by negating the positive Maribozu. So, really, right from 8:30 a.m. this morning, when that news hit, we had a negative Maribozu on that news bar here right at 8:30 as that came out. We were just guilty right from the start. And every other part of it, broadly today, even though we had a great long call out at the 10:15 low, very broadly today, very obviously, today was an easier day to be a trader who's looking to the short side of the market than is looking to buy the market and be on the long side of the market. I just think that the actual execution on the short side, which you can have your thesis that we should be going down, the thesis always has to be confirmed by an executable setup. The actual execution of the short side, I think, was actually very difficult today, unless you took that 9:55 a.m. inside 5 and down that we discussed on the pure momentum. But I think that was a tricky trade because of the degree of extension, even still in a 5-minute chart, to be taking shorts at this time of the day. A lot of the times, if you've got this type of extension at 9:55 and you're taking an inside 5 and down for momentum, a lot of times I think that you're going to see that you're actually not going to get downside follow through. We got the downside follow through today, but I think a lot of the times you're not. It's going to start to break down, probably more than enough to get your risk covered, so it's probably still a trade worth taking, but then quickly you're going to see it kind of hold or bounce back or shake people out and kind of come back up, and then maybe the down move does actually happen, and it just needed another 10 minutes or so for this ADMA to catch up. So great question there, Andrew. Hope it helps. Scrolling down. Nike smoke now. So Nike and Micron are not here to save the day. Micron's flat from where it closed. Nike Retail continues to be no good. Did I see Josh out of the corner of my eye say Under Armour looks like it's going bankrupt? A lot of these companies look like they're going bankrupt, man. Holy cow. Holy cow. What's the game plan for tomorrow? We got PCE at 8:30. I mean, gotta see what the number looks like. It's always hard to really analyze the next day's game plan, I think, the night before. That's why I think it's so important to wake up and do your research early, because we don't know how we're gapping yet. So a lot of how my next day game plan comes together is based on an analysis of the gap plus the new news that occurred overnight. What are the Asian European markets doing? Like to read Pat's note, get an analysis of sentiment, extension, positioning, and then kind of formulate my game plan each morning. As of right now, though, we're back to being $8 extended here in the SPYs as of the close. So we're kind of back into this area where $8 extended, that's an extension for sure, but it's not so extended that we can't continue to go down. We are not so extended that if the market wants to, it could absolutely give us downside continuation tomorrow on bad numbers or just purely technical. So let's assess that in the morning. From Tom, if you have conflicting indicators, technicals versus candlesticks, do you give weight more to one or the other, or just not trade? Sure. So I give weight to usually to whatever the larger time frame is going to be. Whatever the larger time frame is going to tend to be what holds. So just to use, I guess, a basic example, if I've got a bullish candlestick in a bearish market, that bullish candlestick tells me maybe I can get a bounce, but most likely the market, if it's been bearish, bigger picture, the actual technicals are bearish or trending down on multiple time frames, most likely, even though I might get that bounce from that bullish candlestick, most likely eventually it's going to fail. So in that type of situation, it doesn't mean that I won't take the candlestick trade to the long side. It just means that I need to use a much more defensive game plan, because most likely, even though I might get that bounce, that trade is going to eventually fail. Or even if you're just looking at technicals on multiple time frames, right? If you're looking at trends on multiple time frames, if I've got an uptrend on a 5-minute chart within the confines of a downtrend on the daily chart, most likely that 5-minute one's gonna have to fail, right? If I've got an uptrend on a 5-minute chart and I got a downtrend on a daily chart, either the 5-minute chart on the uptrend just continues and continues and continues, and this entire daily chart reverses back up, or more likely that 5-minute chart uptrend eventually falters, the daily chart trend takes over. Maybe that 5-minute uptrend was just a daily chart upside correction of downside extension, and then eventually we're breaking down. That 5-minute uptrend is failing and we're going down. So usually, though it depends a little bit on the situation and all the other factors, and that's what I love about markets. They're so dynamic. There's so many things to assess. But just to give a more generic answer, whatever the larger time frame is, and usually technicals, at least for me, are going to be a larger time frame than like a candlestick pattern, like an individual hammer candlestick or something like that. Usually whatever the larger time frame is going to have more weight to me than otherwise. But the other thing that you want to do, and one of the things that we talk about, is risk skew. Putting more risk on when you feel you have a higher probability of success. So if I've got conflicting information, that means I'm going to have a lower probability of success broadly than if I had everything that was lining up, right? So it doesn't mean that I won't take the trade. I might give more weight to one, side, one piece of information than another. But for sure, if I'm seeing things that are conflicting, it's just going to mean that it might be a trade that I still take, but I'm going to probably look to take it with less overall risk, less overall position size, or what have you. What else, guys? What else you guys got for me? I had no problem wrapping it up early. I'm sorry I wasn't super active in the VTF today. I'm still playing a lot of catch up from having no computer for a couple weeks. A little bit jet lagged too. So I don't mind wrapping it up early as I get back into the swing of things. But I'm of course happy to answer any questions anybody has. Or if nobody's got any, then we can wrap it up and pick it up tomorrow morning and see if the market's at 0 yet by tomorrow. Alright, cool. Looks like we got it. Thanks, everybody. Have a fantastic night. Great to be back. I will see you all tomorrow. Signing off.
I was just putting those